Hey everybody, Tom Gentile. I want to welcome you to the Midday Report. It is Friday, April 24th, 2020. And let me ring the bell here. Glad to have you here with me today. We got another great program. I'm going to be talking about, we're going to do a quick stocks, bonds, currencies, commodities, and I'm going to focus today on intraday trading. So that's my plan. I promised you that yesterday. We're going to do that. I'm actually going to go in and show you some intraday tools using my software, tomsoptiontools.com. We're going to use that, and we're going to actually look at what's going on with the markets. I'll show you some ideas of some stocks that don't fit the pattern, some stocks that do fit the pattern. I'll take some of your stocks as well if you want to share some stocks with me on the chat box, and I'll go through and pick a few of them out, and we'll see if they fit the type of pattern. I got to talk about what the pattern is too. So lots to talk about. Let's go ahead and get rolling. All right. So let me share my screen, the right one. Multiple screens going on here. Okay. So once again, my topics for today include a quick look at the intraday markets. We're also going to talk about my intraday trading strategies and doing something called placing contingency orders. So a contingency order is not your typical order. Most of us that place orders in the room, we are, market orders, for instance, limit orders, stop orders. But I want to show you a little different type of order that I utilize when I'm trying to get in and or out of the markets at a specified time. All right, not every broker offers them, but the big ones do. So that's the plan here for this morning. Hope you guys are doing well. I'm in Central Florida today. Central Florida on the West Coast, on the Bayside, and we've got a tornado watch that is on and is ending here real soon. But woke up this morning to some rolling thunder. I hope you guys are all doing well wherever you are. So, and the bell. Okay, the bell. You guys saw the bell. If you didn't see the bell, let me throw the bell back up here again real quick. This big thing right here. Okay. So this was a gift from one of my family members, and it's a 1905 firehouse bell. It looks really similar to the bigger bell that you see at the New York Stock Exchange. The thing must weigh about 20 pounds. I mean, it is just solid brass. And I'm actually waiting for my brother-in-law to put, I don't know what he's got to put something on it where I can push a button and it bangs like the New York Stock Exchange bell. I was thinking about putting it out on the front of the house. What do you think about this? Putting it out there putting it as a doorbell. I mean, it'll wake the entire house up, but it'll be different. So anyway, love this little thing. Thought I'd share it with you today. All right, I'm going to pop back over to the screen. Let's go ahead and get started. I've wasted enough of both yours and my time this morning. All right, so let's move over. All right, stocks, bonds, currencies, commodities. I say this all the time, and I'm going to say it again today, guys. Being bearish, short in this market ain't easy. It ain't easy. Last night it looked pretty easy as the futures markets were tanking. But look what's pushing the market today. So we've got SPY. All right, here's our opening hour high, 281.29, opening hour low, 278.77. And it looks like we're trying to trend back down there. This is also being confirmed by bonds, which are trending up and about to push through their opening hour highs. All right, we've got UUP, which is down just slightly today. And it is trending in between its opening hour low of 27.22 and 27.16. And look at USO. This is absolutely amazing. When I look at USO, I'm going to actually double this screen up here real quick for everyone. So let's make the first side now the CL-CL. This is the June contract. All right, so the June contract had a low on Tuesday of $6.50 and then pushed up and has been trending higher for the rest of the week. But today, not so much. Maybe we've run into a little bit of headwind here. And if you take a look at the CL contract, we're basically even on the day. So why is USO down? This could be a number of reasons. One could be simply that if you look at, if I go out and I look at, say, the N contract, all right, N20 is July. So N is down half a percentage point, okay? If we look at the Q contract, Q is August. Q is down over 1 percentage point. Do you remember earlier in the conversation this week when I was talking about why oil, first of all, we talked about why oil went negative, and then we talked about USO being one of the biggest, if not the biggest buyers of futures contracts to support their ETF. And they were flipping out of May and flipping into June. Then they realized they needed to flip out of June and flip into some longer months. And so they were, in essence, selling June, buying July, buying August. Well, that created some disparity between those two contracts, between those contracts going out, because oil futures contracts are contracts for delivery that happened later on during the year. So USO was pushing a lot of those contracts higher by selling front month and buying back month. Well, that all stopped. And so now what you're seeing is you're seeing back month contracts coming down as opposed to the front month. And that's what's pushing USO lower right now. But USO is helping to push SPY lower. Right, so if we go back to SPY, and you can see what's going on with the S&P, that it's drudging near the bottom down here. And you know, we'll see where that ends up going. Obviously, time will tell. But last night gave us an indication that the lows in the overnight are down around the 28.55 level, or 275.5. So that's a couple of clicks down from where we are right now. Okay, now I also set these two up here for just a moment. I want to see what we got going on. We do have a reverse split coming up on USO, and I don't think that's causing the sell side. I think the selling in USO by the retail traders is going to happen after the split, the reverse split. So we'll see what ends up going on there. Okay, so I want to talk to you a little bit about day trading. All right, there are a couple of ways that you can hedge risk in this market. All right, a couple ways you can hedge risk in the market, and I want to do a poll. Let's try creating a poll this morning. All right, so the poll is going to go like this: how do you properly hedge risk as a trader? All right, and I'm going to give you a couple of options. All right, option one. Buy and hold for a long time. Okay. Option two, trade with options. Option three would be day trade. And then option four would be all of the above. Now, I'm asking, how would you do this as a trader? Let's see if we can open that poll up. All right, you should have the poll right now. It looks like it's actually active and working. So I just threw a poll out there for you to take a look at and answer. You can choose one of the following. So how do you properly hedge risk as a trader? How are you doing it in your trading today? All right, are you buying and holding for a long time? Are you trading with options? Are you day trading? Or is anybody out there doing all of the above? So I want to put that out there for a moment as we're looking at these markets, and I want to talk a little bit about each of these, okay? Because they are all right answers. They are all right answers in their own aspect. So buying and holding, all right? Now, while none of these are a guarantee going forward, we're looking at them as a past, okay? So buying and holding, for instance, is a process where you're basically looking back 5 years, 10 years, etc. And you're determining based on the long term, going all the way back to World War I, World War II, that if you look at any 10-year period, you're going to see that in any 10-year period that the market has, off of their lows, has moved higher. Even off of their highs, we've come back in the majority of the cases and not only hit those highs again, but eclipsed those highs. All right, since World War II, the stock markets gained on average around 9% per year in returns. So the buy and hold approach actually does work. All right, how about number 2, trading with options? Okay, so trading with options, I'm going to throw a couple of option strategies at you. Buying calls, buying puts, limited risk, right? And if you look at them as a 1 to 100, and what I mean by that is instead of investing $50,000 in a stock, let's say you put $2,500 of that into a call option. Well, what you've done is you have now rented that stock and you're hedging your risk by 95%, right? So that's also a way you can hedge risk. How about taking stocks that you own and protecting them with put options? That's another way you can hedge risk. Okay. What if you're a seller of puts or you're selling put options? Selling put options is a way of acquiring stock and has a higher probability outcome, but is it truly hedging risk? Well, it depends. If you're a short-term trader, I don't know, because you really do have an open you have open risk and you have a fixed reward. But if your intent on selling puts is to acquire the stock because you're selling puts against stock you would own, then yes, you are hedging risk. Now, day trading is another way to, believe it or not, hedge risk, right? All of these things that we think or we've been told are risky, when we come across a world crisis like COVID-19, all of a sudden they don't seem so risky. When you see stocks like Delta Airlines that has gone from the 60s down to the low 60s to low 20s, I guarantee you an option trader that bought call options at 60 didn't pay $60 for those calls. They may have paid $3 for those calls. And those $3 call options have gone to zero. So they lost $3. But someone that was holding Delta at $60 is now down nearly $40 on the same position. Would you rather lose 3 or would you rather lose 40? So that's the area I'm talking about where option trading will leverage that risk. Day trading will hedge that risk even more, because if you're properly day trading, you're in and out and not holding overnight. So you don't have overnight risk. Depending on how long you hold, you might not even have time risk. And we're going to talk about that today. So let's go back and jump back on the screen again, once again. And this time what I want to do is I want to share the poll with you. So here's the poll. Let's rock and roll on that poll. I'm going to show you the results. And here we go. How do you properly hedge risk as a trader? Buy and hold. The buy and hold traders, actually about 6% of you. All right, about 6% of you, 6%, 7%. Now say that buying and holding is how they hedge risk. 47% of you trade with options as a way of hedging risk, whether that is as speculation or protection. Right? There's 9% of you in the room that day trade, and that say day trading is the way to hedge risk, because I don't go home, I don't take my trade overnight. So and a lot of that overnight risk is where the market is. And then there are 32% of you that are saying I do all of the above. Now, I fall into the all of the above category, okay, as a long-term trader. And I've been doing this longer than I haven't. So I should have more than one of these on, as far as my arsenal of trading. So when you look at this and we move forward, we're going to discuss day trading as a way of hedging risk. So to do that, I'm going to walk on over to my option site, tomsoptiontools.com. Let me log in. There are a number of ways that I trade as a rules-based trader. Okay. I can trade using options as a rules-based trader. I can trade using channel analysis as a rules-based trader. I can actually trade using, over here to the right-hand side, even seasonality as a rules-based trader, both on the monthly, even on holidays. I've got holiday patterns. I've got weekly patterns. But today we're going to go into something called the money clock. And the money clock, let me hide those results here and get this out of the way for you. The money clock allows me to go in and look at intraday patterns. So what am I looking at? All right. So my algorithms will go in and we will look at a number of different patterns between 9:30 in the morning and 4 in the afternoon. All right. I got to get rid of this, there we go. I saw the poll come back up again for a moment. Let's get rid of the poll. All right, so I erased it, Nina. All right, so you can see here that that I've got something that looks like a face of a clock. All right, of a timepiece, and that's exactly what this is. This is a timepiece, and what I do is I look at the top 300 stocks and ETFs, and what I'm looking for in stocks and ETFs is I'm looking for patterns that repeat themselves. All right, over the last week to anywhere from 1 week to 30 days. All right. And so I can look at that by minutes in terms of in this case, I'm looking at anywhere from 60 minutes to 4 hours, because I believe that there is that if you go inside of 60 minutes, you really are limiting yourself as to what you can make, especially if you do this as an option trade. So day trading can involve trading stocks openly. And it can involve also trading options on stocks. I think if you trade stocks openly, you can day trade within a few minutes. But if you're going to trade options on stocks, you're going to day trade options, you need some time for those options to actually get up and go. Because again, if you're trading at the money options, what does an at the money option have in it? Typically, it has about half of that option is real value, and the other half, there is no real value. That entire option is time value, but it moves in a rate of about 50%. That's called a delta. So if you get a 1 point move in the stock, you usually get about a half a point move in the option itself. All right. So the reason I'm saying that is that I like the patterns that are about 1 to 4 hours. Okay. The other thing I do is I do a look back anywhere from a couple of days. I can look back all the way to 60 days. But I'm finding right now the last 7 trading days seem to be working very, very well in determining short-term patterns, especially in the coronavirus world crisis that we're in right now. Okay. Now, the next thing we can do is we can utilize our opening hour if we want to, and be more conservative. So for instance, if I were looking at SPY right now and we're stabbing this low, do I really want to look at bullish patterns? Do I really want to look at bullish patterns? No, I want to be looking at something that's trending, especially if it's going to be an ETF. So I'm looking at SPY, and I'm going to look for bearish patterns in the SPY that are going to happen after 10:30. Okay. And so, if I were looking at TLT, for instance, I would be looking at, let's take a look at TLT, put it on the right-hand side. All right, so it's stabbed the upside today. It's pulled back a little bit. But if I'm getting into the green, I might want to look at bullish patterns. How about USO? We saw USO. I mean, USO, first of all, with USO being down here at $2.54, we don't need options on this one. I mean, I've got option trades that cost more. Most of my option trades cost more than $2.50. If I were going to be bearish on USO, I would look at, if I had a pattern on USO, I'd sell it. I'd just sell the actual instrument and buy it back 1 to 4 hours later when the pattern ends. Okay. So stick with me here for a minute. We take these patterns between 9:30 and 4 p.m. and we're looking for what I like to call clusters of bulls and clusters of bears. Okay. So let's start. I'm going to start with the A's, and I'm going to pick a stock that, well, we all know this stock. I mean, how many of you have traded ABV in the past? ABBV. Just put a yes up there on the screen if you're an ABV trader or an ABV holder. All right, so I'm going to find ABV. There's ABV on my chart, ABBV. I'm going to click on it, and now I'm going to get an idea. Now, the way you're looking at this pattern graph here, guys, is that 9:30 starts over here on the left-hand side, and 4 p.m. is on the right-hand side, and these are different on the half hour every day. Now, where you see a little green or red area, that shows a pattern. For instance, if we look at this pattern right here that says 100%, it says that between 11 and 11:20, ABV has typically gone up, all right, in price. Now, what I don't like is that I've got, I've got nothing over here. I got a 100%er, and then the next one's a bear, and then the next one's a bear, and there's a bull over here, and they're just little blips. This kind of looks like Swiss cheese, all right? I don't like trading patterns that are Swiss cheese in the market. So let's take a look at another one. All right. Boeing. We've discussed Boeing on this program a few times. Let's look at BA. So there's BA. Now, What does BA look like? Well, BA kind of looks the same. Got 100%er up here, but we've got another 100%. But look here. We've got a lot of clustering of bearishness going on right in this area. Okay. How about GDX? That's the gold miners index. Oh, this is what we're looking for, guys. Look at this. This is what I call the cluster, where we're getting all these patterns that are clustering together and they're all on the right side. Okay. So that's what we're looking for. All right. Now, what I do is I try to find these patterns, and I look for these patterns, and I look to see, how they do in the marketplace. How about Alibaba? We've discussed Alibaba in here. Alibaba. And Alibaba has a lot of bearishness on it throughout the day. Then there's this little bull down here that kind of doesn't make me feel that great about it. But tell you what, I'm looking at some stocks on the screen right now. I've got someone's asking about Tesla, CMG. Let's take a look at those. So TSLA. I wonder how TSLA looks. Okay, so here's the problem I have with Tesla. It's been kind of choppy in the afternoon. It gets bullish at 2 o'clock. Then it jumps to being bearish at 2:40. So we've got the bullish side here, and then it jumps to being bearish. Now, the way I can rank these, and I'm going to go back and we're going to take a look at Boeing, because Boeing's been very good to us. But I'm going to look at this on a table. All right, so this is a different way that I look at this, and it's what's called a table graph. Okay, and table graphs are showing that there's more short opportunities in Tesla or in Alibaba right now, okay, than there are in anywhere else. And I can actually go through and I can look at these times and even rank them. And we've got our first short actually happens at around 9:55 a.m. Now, if you take a look at the trades over here, all right. So I've got start time, end time. So this is 10:45 to 11:40. This is a 55-minute pattern. Okay, starts at and it averages about $8.18. All right, total during this pattern. So it's a little over $1.17 a day. 100% accurate over the last 7 days. And it even shows you what it has done in the last 7 days. Now I'm going to back up and I'm going to start over again. So we're starting from this area, which is called the money clock. All right. And I'm going to go and hit BA. I'm going to bring up BA real quick. And I see a lot of bearishness in the morning on Boeing. All right. Then we turn bullish at about 11:45. All right, so let's go ahead and take a look at Boeing a little bit more, a little bit closer. So at this point, I see some bullishness. Okay, so I'll go look over and see, and I'll place an order. Now, if I'm going to place an order at 9:55 in the morning on Boeing, for instance, so type in BA. All right, what am I going to do? First of all, guys, and a lot of you know this, but some of you don't. On a day trade, and if I'm bearish, what would you do? Day trade bearish, what option would you take if you were going to trade Boeing bearish between 9:55 and 11 a.m.? So this is like a 1 hour trade. What would you look at? Calls or puts? Don't all of you spell it out right away. I'm looking at the chat box. There's a bunch of you in this room, and either the chat box just went, either I caught everyone with their mouths open, or maybe a little bit late coming in. That's probably what it is. So, okay, puts. Okay, so let's go ahead and add this in. So, do you know that with a day trade and with today for sure, I'm going to go in and put in put. We can actually trade the puts that expire today. We don't have to wait. We don't have to use puts that are 30 days to expiration. If you plan on being in and out of these put options in an hour, the ones that expire today make the best sense. Buying to open. I'm going to put 2 in here as an example. All right. 1/3, the 130 puts. But again, now we've got to kind of take ourselves back a little bit here. So let's go ahead and take a look at Boeing. So here's BA. All right. Wow, nice pattern down, that's for sure. Okay, here's 9:30, 9:45, 950, 955 is where this pattern actually started. So yeah, I know that a lot of you are looking and saying, wow, we lost a lot of money here in the first part. But this is called anybody's game. I'm looking for stuff that typically happens in a pattern. So the pattern starts right here. So in this case, the 133 puts were the closest to the money. So what I do is I look at where we are in the pattern. Let me back this up to where this pattern actually started. All right, there's 945, there's 950, there's 955. So the 955 print is right here, 133.54. The 133s or 134s were at the money at that time. So let's go in and look at those options real quick. All right, .BA 200424 P for put and 133. Somebody else is trading these. we have a group that actually trades these guys, but you know, I'll talk about that later. So we're talking about put options at around the 955 area that we're trading for, and these are the 133s trading around the dollar right here, $1.76, $1.77. All right, so $1.77 where these puts at. So again, let me take you to where this actually started trading. Okay, here's the 955 print, $1.77. Here's where this trade is. Now, I'm taking us back a little bit. Okay, so we're at 955. All right, so what do you do at 955? Do you place a market order? Do you place a limit order? Do you place a stop order? No, you do none of the above. You can place a market order, absolutely, on this 155 put. You can do that, all right. But what I want to show you is something called a contingency order. All right. So some of you in here, how many of you know what a contingency order is? All right. If you know what a contingency order is, tell me yes, I know what a contingency order is. Just put it in the chat box. And if you don't know what a contingency order is, I want you to also say, I don't know. All right, because that'll give me an idea of how many people in this room need me to walk through what a contingency order is. All right, so we got a lot of yeses, we got a lot of nos. So for those of your yeses, please stand by while I show the nos what it is that we're talking about. A contingency order is an order that is contingent on, could be the contingent on a price of the stock going somewhere. All right, but it could be contingent on the time of the day. So here we are, and here's my trade ticket for Boeing. So if I'm going to buy these 130 puts, you know, I could do them as a limit order, but I might not get filled. But I could do them as a, remember, we were looking at the 133 puts. And remember, they were trading around $1.77, $1.75 to $1.80. So if you want them at precisely 955, you have to place a market order at precisely 155. But there's another way you can do that. And Ken, you're right. It's a conditional. It's exactly what it is, a conditional, right? And I apologize for not being able to answer all of your chat questions and responses, guys. You know, when I'm looking at I've got multiple screens. So when I come back and look at the chat screen, I may have missed a lot of what you're saying, and I'm just going to apologize in the beginning. So to do a contingency or conditional order, and this is an example using Schwab's website, is that I would do a market order, but I'd create an advanced order. Now, a conditional order is also contingent. You can do contingent on price. So any of you that look at, maybe you look at Boeing. All right, so let's go back and look at Boeing. And maybe you're a technical trader and you're saying, you know what? If Boeing breaks this this low here, I'm going in. I'm going in and I'm going to sell this. I'm going to buy puts if we break 137.5, which we literally did that on the open of the day today. But the other thing is if you're looking at 955 and you're saying, hey, I want to buy puts at precisely 955 because there's a pattern there at 955. This is how you do it. You do what's called a contingent on time. And a contingent on time order allows you to put a market order in at precisely the time that you want to get into the market. Check this out. Buying these 133 puts at the market, but only at 9:55 a.m. Set that trigger, and now the market is contingent upon the clock striking 9:55, and at precisely 9:55, there's your order fill. Okay. All right. I can't read the numbers. If I were to, let's see, let's open this back up again. If you can't see these numbers, this is as far as I can bring them up, guys. All right, 4:24, 9:55 a.m. All right, this is an example of how to put that in. Now, what do we do at? Well, let's go back and look at the money clock again. All right, so here's an order that ends at 11:40. Okay, so I look at my 9:55 a.m. to 10:40. There's that first hour of the day trade. So 9:55 to 10:40, which means that I'm back out of this trade again at 10:40. So at 10:40, I'm looking at, oh, look at that. I just saw something. At 10:40, I could be looking to get out of the trade. Well, I would do this. I would sell to close those 133 puts I opened, and I could sell them at the market contingent on what? Contingent on the time being 10:40. So what are you doing? You're actually timing the market. You're timing your way in and you're timing your way out. And then you set that trigger, and now your contingent time order's in. And unless you go in there and cancel it, you are trading a rules-based trading system. Let me tell you what's not in here. Fear, greed, emotion. And Sherry, my eyes just glanced to the chat box just now. Yes, this can be done on TD Ameritrade using the Thinkorswim platform. They have a way of creating market orders and doing contingent orders on time. Okay. So anyway, I thought I would share this a little bit with you guys. You know what? I'm going to run a little bit late today. I hope you guys are okay with that, because I thought what I'd do is, we talked about some signals. We did some time contingency. How about I show you a couple of them I'm looking at this afternoon? What do you say about that? So let's look at some that are happening this afternoon. So I'm actually going to go back to my money clock, and I'm actually going to reset it. Okay. And we're going to look at greater than or equal to the 60-minute time frame here. And so I want to show you a couple of them. These are really just some good-looking trades that are coming up. Msft. So Microsoft, right? So Microsoft actually has some interesting stuff going on with it in the afternoon. It seems to be a sell-off in the mid-morning, but come afternoon, we've got some interesting stuff that's going on, and this is one, and here's another one that happens that's 12:05 to basically 4 o'clock in the afternoon. But even the shorter term signals look pretty nice. This is a 7-day look back, and we're looking at Microsoft showing a 13.25 to 14.25. This is 125 to 225, okay, to the upside. So if I go and click on this, then I can see what's happened to it. So a day ago, not much, but look what happened 3 days ago. Microsoft had a nice bounce. And you can see that 6 of the last 7 days, this actually had some nice moves to the upside at the end of the day. Now, in the spirit of hedging, so again, what are we looking at here? We're looking at bullish patterns that are starting at about 125 in the afternoon. Okay, and the shortest term one is 125 to 225. So how would you set that up? Well, again, I'd go in here and I'd look at MSFT. No, that's my Friday afternoon fingers. MSFT, Microsoft. Okay, all options. Now, the 170 calls right now. This is where is Microsoft at this point? Well, let's go in and take a look. MSFT. All right, so Microsoft's trading right in the middle of the range. So it's neither bullish nor bearish. I would love to see it start trending up before we get into that afternoon. But again, we could look at the dot MSFT. Remember, today's options on I think it's one more 200424, C for call, and then I'm looking at what are the at the monies. So the at the monies, and I'm actually going to look at the 171s because they're just slightly in the money. So are there 171s? That's another big question. Is there a 171? They might not even have 171 options. All we got to do is hit the button and find out. Okay, can't find the symbol. So we're going to have to round number this, and we're going to have to look at the 170s. So the 170 calls right now are $1.70 as of this print. $1.70, which means they're literally, look at this, guys. This is beautiful. This is how you eliminate time value in options. You know how you do that? When you got a stock trading at a 171.57 and the options are trading at 185, that means most of this is real value. And there's only about 20 cents. 20 cents is time value. The rest of that, $1.50, $1.60, or $1.65 is real value. All right. So we'd look at this, in the afternoon. So to be a hedger, to be a true hedger, and, you put this in, and we're looking at this as, buy to open, and, and I'll tell you the reason I do a minimum of 2, because what I do is with options, if this thing goes up and makes a 25% return, if I take this, and let's say that I get filled on these at again, it's a market order. Okay. It's a market order, but when? It's a market order at time, on the time. What's the time? 125. Okay. Contingent on time. So this trade goes in at 1:25 p.m. 1:25 p.m. Okay. There's our set the trigger, and at precisely 1:25 p.m. boom, I'm filled and I'm long Microsoft. All right. Then I got to go in and I want to create a couple of orders. If for some reason, if luck has it and we get filled, and let's say we get filled at $2. All right. Well, I'm looking at getting out of half of the order if it makes a 25% profit, and the other half of the order if it makes a 50% profit. Because if you can make 25 or 50% return on an option that you're only going to be in for an hour, that's pretty good. All right. That's pretty good, guys. So I just want to make sure that I set that out there and mention that to you. All right. So when I set the order and I'm filled, I look for a 25% profit on half of my contracts. I look for a 50% profit on the other half of the contracts. If I don't get out of either one, then I've got, if I get out of half or I get out of none of them, then I've got to close them up at the end of the day. So for instance, if I have my closing set at 2:25 p.m., I would sell to close. And, again, where's the pattern? 125 to 225. So at 225, I'm going to go ahead and set that at the market as a contingency on time at 2:25 p.m. to get out. So, I know that it looks a little bit confusing when you're looking at this for the very first time, with the markets. But realize this. Brokers' platforms are better than they've ever been when it comes to being able to place orders other than simply a market or a limit order. We've got contingents on price. We got contingents on time. We have contingents on volume. When stocks reach a certain volume, you can do a contingent on a stock. You can take an option trade contingent on its stock price, not just its option price. Okay. So that's what I wanted to cover with you today. Let me give you one more trade that I'm looking at here. So Roku. Let's take a look at Roku. All right. Let's flip over here. ROKU. Oh, that's ROLU. ROKU. All right. So Roku is trading in the middle of the trend today too. Maybe trying to go up on the upside of the area. Roku's at the money options right now are the 125s. I'm actually looking at potentially a put play in Roku today. So .ROKU. And then we're going to look at, again, today. So today is 200424, P for put. And let's put in the 125s because that's the closest ones. Right now, the 125 puts are trading at around $1.89 last trade. All right. I don't want to do this right now. I want to see what the money clock has because I've already been doing a little bit of research on it. So come on over. Let's look at the money clock and let's type in ROKU. And there's Roku. Look at the cluster at Roku that Roku's showing us. All right, the top one. And these are ranked by, I have them ranked by result. So you can see this one's 100%. The last 7 days, this thing's basically dropped between 225 and 355. Let's take a look at that one. I don't even need to go any farther. All right, so I can see here that this is last 7 days. The market has dropped, and this is profit right here. These greens are not going up. These greens are dollars going in the pockets of people that have been short Roku in the afternoon. So yesterday, Roku did this. All right, between 225, kind of went sideways, went up a little bit, and then it started to move down into the last 5 minutes of the day. So that was a nice little $125 to about 120, below 123. Nice little move there. Okay, so I have all this data that I can work with, but everything shows me that Roku looks like it wants to drop. Now, again, how important is it that if I'm looking at, for instance, now, and I'm looking for Roku to drop into the end of the day, starting when? Not now, starting at 225. But you know what? If SPY is leading the charge to the downside, I'm going to feel a lot better taking bearish positions. What do you think, guys? I mean, if the train's heading south, isn't it better to be running with the train than running head on against it? I believe so. All right. So if we're going to look at Roku, and we see these 125 puts, maybe by the time 225 gets around, and that's going to be, a little less than 3 hours from now, this might already be down. It may not be the 125 puts I'm looking at. It might be the 120 puts I'm looking at, because we might be down on the day. So that's just another idea I want to throw out there for you. All right, so the Roku, let's go back to the Roku once again. All right, so take a look at this. 225 to 355. How do you put that in? Well, you put that in just like this. ROKU. All right, I'm looking at put options that expire today. So buy to open, and then, of course, whatever number of contracts you put in, the 124 puts showing 89 by now. We could actually look and we could say, all right, as we're getting closer and closer to 225, I'm going to be looking at where at the money is. But basically, you're looking at spending about $1.25 on an at the money put. That's what it looks like. So you already know what your risk is. Okay, if it goes completely against you, all the way up to 355. Right, and I'm looking at these now. I'm looking at the options that are closest to expiration. So on Monday, I could be looking at Friday's options, but on Friday, I look at Friday's options. Okay. So, and again, follow the rules. I get in when during the pattern, when the pattern starts, and I get out when the pattern ends. Or if I get if I make 25%, I'm going to get out of half of it. If I make 50%, I'm getting out of everything and calling it a day. And there's been several days where these patterns have resulted in a 50% profit, maybe within half of their time. Half of their time frame. Okay. Again, how do I put this in? Buy to open 2, and this is an example. 2 could be 20, could be whatever you want. You decided to be based on your personal risk profile. 124 puts. I'm not buying them at the limit. I'm doing it in the market, but I'm not buying them at the market. I'm buying them at the market when we reach. Get this. Contingent on time. 2:25 p.m. Set that trigger. If you like that, you place that order. That's it, guys. That's the trade. And I might have to now, if I come back and it's closer to 225 and Roku has gone up or gone down away from 124, I might have to modify this order and go back and look at the record. Go back and look at where those options, where the stock's trading at, because I want those at the money options. Okay. So why do I choose the at the money options? Because that's where all the volume is, and that at the money options can have the best change coming right off the bat. It can become in the money very quickly. Now this one right here, because we're taking a Friday option all the way out to 3:55 p.m. This is one that could expire worthless if it goes against us, which is why we want to look at, again, why we want to look at these options and realize that your worst case scenario, especially on a Friday, your worst case scenario is going to be that in Friday afternoon, these could go very, very close to zero. If you're taking a trade like a Roku trade on a Monday and you're using the Friday options, they're going to still have 4 days of time value left in them at the end of Monday. But on Friday could be your biggest winners. It could also be your biggest loser. Okay, so I want to put that out there for you. All right, so last thing I'm going to throw out there for all of you is that for more information on this, I mean, I utilize this right out of my right out of my software, Tom's Option Tools. But Money Map Press, we do a premium publication, and I'm just going to do a little shameless promotion here real quick because a lot of you are kind of asking about this. We have a subscription that is called the Daily Flash Cash, and the Daily Flash Cash membership has more information about exactly what I just talked about. Okay. Not only that, but we have, again, the money dial is right here within the Flash Cash program. So you can see the money dial. And I'll just show you again, if we're looking at Roku, ROKU, there's all those bears. There's all the bulls in the morning. They're 86%. All right. But all the bears are 100%. And I love the 100% trades because 100% of that past has worked. There's no guarantee it's going to work going forward. But you know what? If I see the same thing happening over and over again, you can bet I'm going to be on that side of the pattern. Okay. All right, guys. And that is it for me as we are way past my time. So I'm going to call time here and just kind of share this with you guys. So, we've talked a lot about the markets over the course of the week. We've talked a lot about options. All right, we've gone into many areas, both for the position trader, all the way to the day where we're talking about intraday trading. So again, whether you're on the long term, whether you're a buy and hold trader, whether you're a 30 to 60 day trader, or even a 30 day or less trader, or even a day trader, one thing is consistent that you're going to hear come out of my mouth. All right, and that is that as rules-based traders, we spot repeatable, repeatable objective trading patterns. That's number one. All right. When we find a repeatable objective trading pattern, that's one that doesn't have hope in it. It doesn't have fear. It doesn't have greed. You can't backtest that stuff. We backtest using quantifiable data. Okay. From there, what we do is we go to create a low risk and or high probability trade using options. All right. That's the alternative to buying stocks if you're bullish and shorting them if you're bearish. And then finally, what we look at doing is planning, executing, and managing those trades. I just showed you exactly how to do that using day trading techniques. All right. Did we not spot opportunities? Yes, we use time-based patterns. Did we not create low-risk trades? Yes, we did, because this right now, by the way, this is the only thing that I'm doing in my trading that involves straight out call buying if I'm bullish or straight out put buying if I'm bearish, because these are options that are cheap enough where you can see some sort of a return without a diminish in time value that could exceed your return. And then finally, did we not plan, execute, manage? Did we not go through that process? Yes, we did. We did that using contingency orders on the start, on the finish. We talked about checkmating the markets. And what I mean by checkmating is when I'm in a trade, here's my profit. Here's what I'm getting out. I'm going to get out if I go 25%. I'm going to get out if I go 50%, or I'm going to get out when I hit the exit time. All three of those instances, we're out. Okay. In none of those instances did I say, I hope it goes up. Gosh, I hope it doesn't go down. All right. We've checkmated the market and we've executed our trades from start to finish. And that's what becoming consistent and having consistency in trading is all about. All right. And also, let me remind you, as we're going through COVID, that, I've got a kind of another 3 set of rules that you see on the screen behind me here. All right. Which is what? Step 1, that we're going to take less risk in our trades. Step 2, that we're going to look at what goes up in a down market. And that includes put options and put spreads. And step 3, again, we want to exploit volatility. And exploiting volatility means as we get outside of day trading, that might mean selling options instead of buying. And oh, by the way, did I not mention, for those of you that are call sellers or put sellers, that you could take a day trade in something like a Roku or a Microsoft or something that has extremely high priced options. And if you're bullish, maybe sell that 1 day put all the way up until the time runs off the clock at 3:55, or sell that call if you're bearish. All right. If you have, again, the account size and the experience to do that. Now, one thing I want to leave you with is with day trading is what's called, if you're classified as a pattern day trader, you're going to need a $25,000 account to do the type of strategies that I'm showing you if you do them every day. To not be classified as a pattern day trader, maybe you do it once a week. Maybe you decide Fridays are going to be the days that you do your short-term trading. It's completely up to you. All right, guys. Hey, thanks for being part of the program, guys. Again, I'm Tom Gentile. See you again next week. I'm going to have a change in my schedule after the end of April. I'll share more of that with you as we get into the final week of the month of April. Till then, have a great weekend, and I'll see all of you again right here, same time, same channel. We got to get into fast food. I kept promising we're going to talk about fast food. All right, we're going to get into a couple different industries next week. So next week we'll be doing Industry Week, and what I'll do is I'll take a different industry and we'll look at the flyer and the dyer of those industries, and we'll create some hedge trades out of those. All right, so again, have a great weekend, and I'll see you again on Monday. Bye now.